Here's why you should never pay cash. For our long-term savings, we're going to put $10,000 a year for 30 years in a non-interest-bearing account, like savings accounts are basically now. We'll start at age 35, and at the end of 30 years, the balance is $300,000. This is our goal and the amount for comparison. Let's illustrate buying cars. We're going to buy a $30,000 car every 4 years. We're going to take out a conventional bank loan, pay it back in 4 years, and buy another car. We end up buying 6 cars over a period of 30 years. Using conventional bank financing, let's assume the interest rate is 6%. After 30 years, we still have $300,000 in savings and spent an additional $8,658 a year paying the bank back. Well, plus interest of $27,786. There are some experts who hold the mistaken belief that cash has no value. So instead of financing your purchases, you should just pay cash. Let's see where that gets us. If we withdraw $30,000 every 4 years and not pay it back, we end up with $120,000 in 30 years. Not surprising, but not great either. To get our savings back to $300,000, which was our goal, we could repay ourselves at the rate of $7,500 a year, putting it back into the account. Here's the first thing that ought to make you think twice. To end up in the same financial place in 30 years, you would, and most people do, pay the bank willingly $8,658 a year. And you have to pay the bank what they tell you and when they tell you to. But you might only pay yourself, and by extension your family, only $7,500 a year. What would happen if you treated yourself as good as you treat the bank and actually paid yourself back at the same rate? At the end of 30 years, you'd have $327,000. So that looks like a good thing to do. So far, we've assumed that you are storing your money at $10,000 a year in a checking or savings account making little or no interest, which is what is happening today. How could you treat yourself like a bank owner and do better? You start thinking like a banker. Let's assume you could find a 4-year certificate of deposit, a CD, that would pay 2%. You would withdraw the cost of the car every 4 years and pay yourself back at $8,658 a year. That could gross almost $439,000, but it's subject to tax. Assuming a tax bracket of 35%, that brings us down to $395,000. It's still an improvement over paying cash. But could we do better? What if we used a different kind of growth-oriented financial instrument, like permanent life insurance? We're going to use some example values for a 35-year-old. To buy cars, we will take loans against the growing cash value of the life insurance. We will use a loan rate of 6% and pay it back, again, at $8,658 a year. After 30 years, the life insurance policy's cash value could grow to $368,000. But there is better news. Growth in life insurance is tax-deferred, so long as the policy remains in good standing. So we can turn off the taxes. The cash value now after 30 years is $413,000. With exactly the same cash flows, we can go from $300,000 to $413,000. So let's summarize. By treating our finances the way a banker does, we increased our nest egg by over a third, from $300,000 to $413,000. We've owned the same number of cars, and since, from the dealer's point of view, we paid cash for those cars, we could take advantage of every rebate possible. We might have even gotten better cars. We've never had to ask for a loan approval or get turned down for one. We've never had any minimum required payments or late fees, just in case something happened during those 30 years. At the same time, since we used permanent life insurance as our privatized bank, at the end of 30 years, we've also created a tax-free death benefit of over $800,000. So really, never pay cash.